Hey everybody, Craig Stanley here again from Summit Group. So first and foremost, I hope that you, your family, and your friends remain happy and healthy during this tough time. I know it's not easy. We're in this together, and I'm confident that we're going to make it through together and be better off for it. But in the meantime, we certainly are sending our best to you. And if you do need anything, please feel free to reach out. We're here for you. With that said, what I wanted to provide you today was a quick update on the market as it relates to the coronavirus, as well as provide a few tips and ideas related to those of you that may still be considering retiring in the next 5 years. So first, a quick update. The broader US market indices, as of the making of this video, are down about 30% from their peak. Now this, as I said in a previous video, is something that we have seen before. It is not completely uncommon. Right now, based on previous corrections we've seen, this probably is around the 8th largest drop that we've seen. But again, certainly within the ranges of quote unquote normal. What we don't know is the recovery period of this and how long this lasts. There's still a lot of unknowns here. I think one of the biggest unknowns is how quickly can we get handle on the coronavirus outbreak and start to see that curve go in the other direction. I think that once that can occur and there's some indication that businesses will get back to work, that's when maybe the market could get some legs under it and we could start to begin seeing a recovery. The average recovery period, as you can see on the chart, has ranged from anywhere from 3 months up to 63 months over the last, the 10 biggest decreases that we've seen. So a pretty broad range. And I think a lot of that is going to also depend not only on the coronavirus cases, but also if our banking and credit industry can remain solid. Right now, banks are still loaning money. They're being helped by the Fed. So we're not seeing a crumbling financial institution issue at this point like we did in 07, 08, 09. So if we can maintain that and keep our banks liquid, then we may be able to see a quicker recovery once we get a handle on that virus. But if banking and financial institutions start to have trouble, then that's where this recovery could last a little bit longer and why we've seen longer recoveries at times. So with that said, we are also probably in a recession at this point. A recession, by definition, is 2 quarters of negative gross domestic product, or GDP. We've been expecting a recession for some time, or thinking that we could enter into one just because it's been such a while since the last one. We just didn't know what was going to take us into it, and it seems like this may be the event to take us there. With that said, recessions aren't always, again, on the lines of 07, 08, 09, and we wouldn't expect that as long as our banking and financial institutions can remain strong. So we will know for sure if we were in a recession once those 2 quarters pass, but certainly where we're the trajectory right now would say that we are in one. So when it comes to our retirement portfolios, let's circle back to that now. First of all, those again that are 5 years plus from retirement, this is probably really a non-event as it relates to your long-term savings. Stay with it, stay invested, continue to contribute. You'll take an opportunity likely in buying things on sale. So just keep doing what you're doing. Remember the fundamentals. For those of you that are potentially closer to retirement, I wanted to give you a few more ideas and thoughts. Now, first of all, this is the worst time to sell anything. So please, if you're nervous, if you're concerned, talk to us, talk to a financial professional, but don't sell at the bottom. This would be probably the worst time to actually realize the losses that you may be seeing just in value at this point on paper. You still hold the same stuff, and we would encourage you to keep holding that and not sell at what could be very close to the bottom, or even if it's not already down 30%. That just wouldn't be a good idea for your long-term outcome. Now, as I've mentioned before, one idea to kind of give yourself some peace of mind is to look at your portfolio and do it with us or financial professional if you need to, but identify what is actually, how much of your portfolio is actually in the stock market and impacted by this significant decrease, and what is sitting more conservatively in bonds and cash. Ideally, we want to have between 3 and 5 years worth of what we're going to need in retirement sitting in that defensive part of our portfolio. So look at your portfolio, think about what you're going to need every year in retirement and determine whether or not you already have 3 to 5 years worth of that sitting defensively. If you do, then there'd really be no reason to try to sell your stock at this point and realize a loss, because you've already got stuff sitting outside of the stock market that you can access without having to sell at a significant loss. Whether you have that or not, if it would give you more comfort, another idea that you could enact would be to adjust your future contributions that you're currently still saving into your retirement plan and put those into the cash equivalent within your plan, being typically a money market or a stable value fund. You do have the ability to maintain the investments that you have in your portfolio without selling those, but redirecting your new contributions to a more conservative investment. To do that, you could typically do that online with most retirement plan providers, but I would encourage you to pick up the phone and call them so that they understand what you're trying to do. But if you liked that idea, the general instruction would be to put your future contributions into the cash equivalent of the plan. If you're not sure about that or have more questions, reach out to us and we can certainly help you. But that would be another way to continue to build up more cushion, more conservative holdings, so that if and when you retire in the short term, you can start using that if the markets have yet to recover. So hope this video has been helpful today. We're going to continue to give you more information as it comes out. But again, we're here for you if you need us, so please don't hesitate to call us or email us. Take care, everybody. We're going to talk to you soon.